Sea Limited once stood as a titan in Southeast Asia's tech scene. The company, headquartered in Singapore, captured global attention. Its diverse portfolio included e-commerce, online gaming, and digital financial services. These segments, Shopee, Garena, and SeaMoney respectively, fueled its ascent. Each arm of the business catered to a burgeoning digital consumer base. At its peak, Sea Limited reached a staggering market valuation. In late 2021, the company was worth over $200 billion. Shopee became a household name in Southeast Asia and made inroads into Latin America. Garena produced Free Fire, a massively popular mobile game. SeaMoney aimed to revolutionize digital payments and financial services in the region. Founder Forrest Li was often lauded for his vision. Investors poured billions into the company, betting on its continued dominance. However, this meteoric rise was not destined to last indefinitely. The very factors that propelled its growth eventually contributed to its challenges. The story of Sea Limited serves as a potent reminder. It shows the volatile nature of the tech industry. It also highlights the complexities of sustaining hypergrowth. Understanding this journey is crucial for grasping the current tech landscape in Southeast Asia and beyond. The COVID-19 pandemic, beginning in early 2020, acted as an unexpected catalyst for Sea Limited. Lockdowns and movement restrictions became the new global norm. People worldwide turned to digital platforms for work, entertainment, and daily necessities. This shift dramatically benefited companies like Sea. Shopee saw an explosion in demand. Consumers, confined to their homes, relied heavily on online shopping. Garena's flagship game, Free Fire, became even more popular. The game's revenue contribution to Sea Limited grew significantly during this period. The company reported record revenues quarter after quarter. The pandemic also accelerated the adoption of digital payments. SeaMoney, Sea's fintech arm, benefited from this trend. More consumers and merchants transitioned to cashless transactions. This period of accelerated growth, however, masked underlying vulnerabilities. The pandemic created an artificial environment. It temporarily inflated demand for digital services. The true test for Sea Limited would come when these extraordinary circumstances subsided. As the world moved into 2022 and beyond, the macroeconomic climate changed dramatically. The era of cheap money and low interest rates came to an end. Central banks globally, led by the U.S. Federal Reserve, began aggressively raising interest rates. This was a direct response to combat surging inflation. This shift had a profound impact on tech companies, particularly growth-oriented ones like Sea Limited. Higher interest rates made borrowing more expensive. They also made investors more risk-averse, leading to a re-evaluation of high-growth, low-profit tech stocks. The global economic slowdown further compounded these challenges. Consumer spending, which had been robust, started to show signs of weakness. Discretionary spending, in particular, was hit hard. This directly affected e-commerce platforms like Shopee. The explosive growth seen during the pandemic began to normalize, or in some cases, reverse. Furthermore, geopolitical tensions and supply chain disruptions continued to create uncertainty. The war in Ukraine, for instance, had far-reaching economic consequences. For Sea Limited, this changing economic landscape meant a tougher operating environment. The tailwinds of the pandemic had turned into significant headwinds. The company had to demonstrate a clear path to making actual profits, a stark contrast to its previous modus operandi. Beyond the challenging macroeconomic environment, Sea Limited also faced internal issues. Some of these were self-inflicted, stemming from its aggressive expansion strategy. The company had pursued growth with remarkable speed, often entering new markets without a clear, sustainable plan. Shopee expanded into several Latin American countries and even Europe. These ventures were costly and faced intense competition from established local players. Management decisions also came under scrutiny. There were concerns about the company's cash burn rate. Sea was spending heavily on subsidies and marketing to acquire customers. This strategy became unsustainable in a changing economic climate. Investors grew increasingly worried about the lack of profitability. The company's valuation itself became a point of contention. At its peak of over $200 billion, Sea Limited was priced for perfection. Any sign of slowing growth or missed earnings targets could trigger a sharp correction. Furthermore, there were reports of internal challenges related to company culture and talent retention. The need to cut costs and restructure operations also led to layoffs. The Great Unraveling sees stock plummets. Macroeconomic pressures and internal missteps led to Sea Limited's dramatic downturn. From late 2021 to 2023, the stock price collapsed. It plummeted from over $370 per share. Market cap shrank by over $100 billion. This was a significant wealth destruction in tech. Investors watched in dismay. The decline was sharp and painful, often following disappointing earnings reports. Shopee pulled out of markets like India and France. Garena faced challenges and Free Fire's growth slowed. Management, led by Forrest Li, implemented cost-cutting measures. The Great Unraveling forced a fundamental reset for Sea Limited. Grab Holdings, a parallel journey of ambition and adversity. Grab Holdings, another Southeast Asian tech giant, started as a ride-hailing service. It quickly diversified into food delivery, digital payments, and financial services. Grab aimed to become an indispensable super app for the region. It attracted massive investments, including from SoftBank. Grab went public in December 2021 through a record-breaking SPAC merger, the largest SPAC deal ever, valuing the company at nearly $40 billion. However, it listed just as the global tech market began its sharp downturn. The macroeconomic headwinds that battered Sea Limited also hit Grab. Like Sea, Grab's business model relied heavily on subsidies, leading to significant cash burn and losses. Mirrored challenges, overvaluation, and shifting sands. The stories of Sea Limited and Grab Holdings reveal several mirrored challenges. A primary issue for both was overvaluation. During the tech boom, fueled by low interest rates and pandemic-driven digitalization, investors were eager to back promising tech companies. This led to valuations that were often disconnected from fundamental financial performance. Both Sea and Grab benefited from this exuberance. They raised substantial capital at high valuations. However, this also set them up for a sharp correction when market sentiment inevitably turned. Both companies relied heavily on investor capital to fund their aggressive growth strategies. The growth at all costs mantra was prevalent. They poured money into market expansion, user acquisition through subsidies, and diversification into new ventures. This model works when capital is cheap and readily available. However, when interest rates rose and investors became more cautious, this lifeline tightened. The pressure shifted from demonstrating user growth to proving a clear path to profitability. This was a difficult pivot for organizations built on rapid scaling. Changing consumer behavior post-pandemic also played a crucial role. The consumer recalibration, new demands, old habits. The post-pandemic world brought about a significant recalibration in consumer behavior. This shift had a profound impact on tech companies like Sea Limited and Grab Holdings. During the height of the pandemic, digital services were not just a convenience, they were a necessity. Consumers embraced online shopping, food delivery, digital payments, and online entertainment with unprecedented enthusiasm. This created a surge in demand that temporarily inflated the growth prospects of companies catering to these needs. As restrictions eased and life began to return to a semblance of normalcy, consumer priorities shifted. People started spending more on experiences like travel and dining out. They also returned to in-person shopping. While the convenience of e-commerce and food delivery ensured they remained part of the consumer landscape, the intensity of their use declined. The at-home economy, which had boomed, started to shrink. This meant that the hyper-growth rates experienced by Shopee and Grab's delivery services were no longer achievable without significant and costly incentives. This consumer recalibration forced Sea and Grab to rethink their strategies. Navigating the future, the long road to sustainable profitability. Looking ahead, both Sea Limited and Grab Holdings face a challenging path. Their primary task is to achieve sustainable profitability. The era of prioritizing growth at any cost is definitively over. Investors now demand a clear and credible route to positive net income. This requires a continued focus on cost discipline. It also means making tough decisions about non-core or unprofitable business segments. Streamlining operations and improving efficiency will be paramount for both Singaporean tech giants in the coming years. Rebuilding investor trust is another significant hurdle. The dramatic stock price collapses have eroded confidence. Both companies need to demonstrate consistent financial performance. They must meet or exceed market expectations. Transparent communication and realistic guidance will be crucial. Showing that they have learned from past missteps and are building more resilient business models will be key to regaining favor with the investment community. Adapting to the new market reality also involves navigating ongoing competition. The Southeast Asian tech landscape remains highly competitive. See and Grab must innovate continuously to differentiate their offerings.